He's Wells Fargo's managing director and senior retail analyst. What are you beginning to see in these names? And I was struck in the last hour. Kelly had up on a graphic of a lot of the hospitality names, from Airbnb to Hilton to Wyndham and so forth, all guiding down, all saying it's not the quarter is going to trend lower than previously anticipated. What's going on?
Yeah. Hey, Tyler. So, look, at the end of the day, I think not a lot is changing, certainly for the better, for the outlook of the consumer, especially in discretionary. You know, the numbers you're starting to see in the second quarter are showing you little red flags, just to kind of take the term from our note. But I think our larger concern is, what do these flags mean for the back half of the year? So we highlight a few different things that really concern us. Number one, markdown risk. We are seeing in real time the inventory situation get a little bit worse, markdown rates getting a little bit higher. You factor in then in the back half, you've got an election. We've done a lot of work around what that means to spending. It's not good. We could go through that. And we have a shortened holiday, 5 fewer selling days this year. Then you tack on things like elevated freight, spot rates and surcharges. What do these mean to margins into next year? Tariff risk. People are already talking about that. It's really hard to find good news in the space today. So valuations are cheap, but that's never really a catalyst.
Let's bear down on that one thing that you brought in that is a little bit unanticipated, at least by me, and that is the idea that the election affects what consumers do and how much they spend. Why is that? Where do you see it?
Absolutely. Look, we put out a big report a few months ago to talk about this, because it has become much more topical with our investors that we speak with. What does it really mean? When we go through election cycles going back 30 years, what we can see in the data is that there is roughly a 150 to 200 basis points slowdown in spend in the back half of an election year versus the first half. That has become much more exacerbated in the most recent elections. Why is that? Because when you look at the data, people are on their phones more, they're watching the news more, they're sitting on the couch kind of debating, who do they want to vote for? They're not spending. This polarization of politics really does take a number on spending.
Their attention is distracted. Their attention is lured away from what they might otherwise be doing, which is going out and spending money.
That's what Amazon is arguing. That's interesting, Ike, that you think there might... I thought that sounded like the dog ate my homework kind of excuse,
no,
personally.
It's true.
Well, and here's what Barclays said, as I'm sure you're aware this morning. They downgraded all of retail to neutral and said, from this point in the recovery cycle, the only way to drive further margin expansion is blah, 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 blah. We believe the majority of forward outlooks have far less upside opportunity and potential risk to sales and margins in the back half of this year, which echoes what Tyler said about the unusual nature of what we've heard from the travel companies. That was supposed to be a bright spot. I understand hard goods or soft goods retail retrenching, but this seems to be broad-based.
Yeah, and again, I can speak most notably to discretionary and soft lines within this. And so at the end of the day, I think that, to take it more near term, the checks we wrote about most recently for the first couple of weeks of back to school are not very good. You're having a slowdown in demand. You've got sourcing concerns that are growing. But the global vendors, like look at Ralph Lauren today, a really, really good print, stocks down. Europe, China, it's almost like, like I said to start, you're struggling to find the good news. There's, idiosyncratic long ideas do exist. We still like some of our stocks. We're not negative everything. We're not downgrading the sector. Burlington within the off-price space is our top idea. Gap is our favorite margin recovery story. There are names out there that are worth owning and buying on pullbacks. But again, broadly speaking, I think it's tough sledding for now.
Broadly speaking, is this slowdown something that is across the board, or is it concentrated more in those retailers that cater to what Diamond would describe as the bottom 50% of earners?
No, it's not that. I think low end has been under pressure for, let's call it 2 years, but I would actually argue in some cases the low end pressure is almost normalizing. I don't know what the right word is, but look at for example, the off-pricers have the most consistent traffic of anyone right now. That's the lowest end consumer that we deal with, but their business model and their mousetrap really, really works. But it's broad-based because, look, we could talk about Ulta Beauty, Bath and Body Works, candles. We could talk about apparel. We could talk about footwear with Nike. It is across the board. It's discretionary spend in general.
Ulta was the stock everybody loved 6-9 months ago, and now obviously, as you see there with the slide over the last 3 months, 17% in Ulta.
I mean, we haven't underperformed on Ulta. I think we're the only one on the street. So we think that they have some issues. They need to reset their business. The margins are too high. The category is slowing. They're losing market share to Sephora. I think Amazon's a problem. So I do think that they have a good amount of problems to deal with.
Interesting. Ike, thanks so much for your time today. Ike Boruchow with Wells Fargo. He's a senior retail analyst there.